788 39. First thing on the agenda is just Anna, roll call.
Mr. Victor Bonilla III.
Present.
Mr. Cruz Mata. Absent. Mr. Ricky Mosa.
Present.
I'm sorry, Mr. Vince Martinez.
Here.
Mrs. Peggy Young. Peggy.
Oh, I am here.
Mr. Simon Houston. Absent. And Mr. Gabriel Espinosa.
Yeah.
Right.
Okay. Item number 3, moment of reflection.
What time did we call the meeting to order, sir?
6:30, I mean 5:30, on the dot. Item number 4, audience to patrons. Don't have any. Okay, item number 5, action, item A, discussion action to approve the district's annual financial report for the 2023-24 school year ending in August 31, 2024. Andreones?
Mr. Eid will, and Mr. Solomon will present our annual financial report.
Good afternoon.
Good afternoon.
You should have a copy of the audit report in front of you. If you will turn to page 3, this is a certificate of the board where the board will either need to approve or disapprove this audit tonight. Turning to page 5, this is your audit opinion. You received an unmodified opinion that in our opinion, the financial statements are presented fairly in conformity with general accepted accounting principles as of the end. Yes, sir.
Can you just have Mr. Houston settle now? He just came in so that he can follow us.
Okay, I'm sorry. If you'll turn to page 5.
Yes, sir. Thank you.
This is our audit opinion. Okay. This is our audit opinion. In our opinion, the financial statements are presented fairly in conformity with generally accepted accounting principles as of August 31st, 2024. Starting on page 8 is the management discussion and analysis. This is the same information that's presented in the body of the financial statements, but it's presented in a graphical and narrative format. As we go through here, you'll see we have condensed comparisons to prior years. We have pie charts of your revenues and expenditures. Again, this is the same information, but it's just presented in a different manner. The body of the financial statements start on page 16. On page 16, this is the statement of net position. This takes all of the funds of the school district and presents them all together under the full accrual method of accounting. You normally keep your books and records on the modified accrual method of accounting, and then we're required by general accepted accounting principles to convert them to full accrual method of accounting for these two first schedules. This is a good schedule because it shows all of your assets, your capital assets net of depreciation, plus it shows all of your liabilities for your pensions and other post-employment benefits. It also shows our bonds and our other debt that's required. So going down this page, the top part of our page is assets, the middle is our deferred outflows of resources, and then we have our liabilities and then deferred inflows and then our net position at the bottom of the page. Our total assets in the end of the year, and this is district-wide under the full accrual method of accounting, was $55,827,000. You can see that we had top part, we go from the liquid assets to the less liquid. So we had cash of $2.5 million. Our property taxes at the end of the year, $2.3 million, net of an allowance for doubtful accounts of $279,000. We had some due to other governments, some small assets, and then we get into our capital assets. We had land of $92,000, buildings net of depreciation of $47 million. We had furniture and fixtures net of depreciation at $2.4 million, and then we had construction in progress at the end of the year of $425,000. Again, total assets $55,827,000.
So, just one point. End of the year, though it sounds like it's January, that just happened. This end of the year is our end of the year, which is August 31st. And again, this combines everything, all of our different funds and all of our different holdings. So for example, when you see buildings, that's not what the building is worth. That's what we paid. Those were our out-of-pocket, what our out-of-pocket cost either to acquire or construct.
Do we have any questions from the board? Was he going a little bit fast? And we have a couple of board members that are new, and I want to make sure as we go through it.
We get into the fund statements that you are normally used to seeing. I'll try to slow it down, but this is, I'm not gonna say it's information you don't have in control of, but like when we get into our pensions, which.
Well, just in case, I mean, somebody has some questions.
Yell at me if you do, please, stop me if you have a question. Like when we get into our deferred outflows, this is basically dealing with our, part of that, the 695 was our deferred charge on refunding our debt that happened many years ago, and we're amortizing that over the life of that loan. However, those big items there, the 3.6 million deferred outflows for pension and the other post-employment benefits, this is information that basically comes to us straight from teacher retirement system. It's information that really you have no control over. We just get that information and we're required to drop it into your financial statements. You'll also see later on, we'll get down that you have some pretty good sized liabilities for that. Again, this is something you have no control over. The things that you do will go on down to the liabilities. We had a little bit of accounts payable, bills that were incurred but not paid until after the end of your fiscal year of $90,000. Other large items, we had accrued wages payable because at the end of the year, school starts earlier than August 31st, so we have some wages that are accrued but not paid until in the next fiscal year. So we accrue those and expense those to get a good cutoff between what actually happened in this current year. We get into some of the larger items under the non-current. We have $2.3 million worth of loans and leases that are payable in the next year. Again, we'll see a note on this later on that'll show you a detail of those. We have total notes and bonds and notes and leases at the end of the year, long-term, of $33,245.
33 million.
Yeah, 33 million, that's a little different. We also had a discount on our bonds of 2.1 million that again is being amortized just like the deferred charge is over the life of those bonds. And you'll get expense that a little bit every year. Then the big items, the 10 million and the 4.5 million for pension and other post-employment benefits liabilities. That's what I was talking about earlier. Those are your share of if everyone was to retire, what the school district would have to pay. This is a large number. It's no different for any other entity. When the Governmental Accounting Standards Board required us to start putting the pension liability and the other post-employment benefit liability, almost every school district in the state of Texas, every city came up with a negative net position, net assets because of this. So you're no different. This is just your share of that liability. Also, we get into the deferred inflow of resources. This is the same information. This is just information that comes to us from the TRS, and we're required to drop that information in. When you look at our net position, we had $13 million that was invested in capital assets, net of debt. We had $643,000 that was restricted for federal and state programs, $3.6 million that was restricted for debt service, 1,222 that was restricted for capital projects, and then we had an unrestricted net assets of a negative $15,451,000. I want to skip the next page because I think we'll see it a little bit more what you're normally used to seeing on page 18 and 19. This is the balance sheet for the various different governmental funds that you have.
You're in what page?
18, 19.
What page?
Page 18 and 19. We have four funds. We have the general fund, the special revenue fund, the debt service fund, and then the capital projects fund. And then we've got a total of all of those on the far right-hand side of the page under the total governmental funds. Follows the same format. We have our assets at the top of the page, our liabilities and deferred inflows at the middle, and then our fund balances at the end. So going down the general fund, column number 10, you can see that we had total assets in the general fund at the end of the year of $2,685,864. We had a negative cash amount of $371,000. We had property taxes that, had been assessed for all years and not collected at the end of the year of $1.7 million. We have an allowance for some that we think are not collectible. You normally will collect all of your property taxes because eventually those property taxes will be sold if someone doesn't pay for their property taxes. However, there's a certain amount for business property taxes where people have have to pay tax on, say, their furniture and fixtures of their businesses. And sometimes you will never collect those because if that business goes out of business and leaves town, there's no assets for the appraisal district to come in and sue to get. So we do have an allowance, but for most of the part, all of your real estate taxes, eventually when that property changes hands, there's a lien attached to it, so you will get that money eventually. We have an amount that's due from our other governments of $204,000. The general fund has a due from other funds of $1.3 million. Again, total assets, $2.6 million. We're on page 18. The liabilities of the general fund, we had $2.5 million worth of liabilities. Accounts payable at the end of the year, again, bills that were incurred but not paid until after the end of the fiscal year of $90,000. We had, again, accrued wages for the general fund of $705,000. And then we had due to other funds, and we'll see some breakdowns of these later on in our notes, of $1.4 million. A little bit of accrued expenses, and then the unearned revenue of $2.68, which is amounts that we receive from the state, but we will report those as revenues in future years. And then the unavailable revenues for property tax of $1.5 million. If you'll notice, that is the offset to our property taxes minus our uncollected allowance for uncollected taxes. So if you take the 17 million and subtract the 206 off of that, that's going to get back to that 1.5 million unavailable property taxes. When we subtract our liabilities and our deferred inflows from our assets, at the end of the year, we had a negative fund balance in the general fund of $1,374,502. Special revenue fund, we had total assets of $44,651. Again, we had a negative cash in the special revenue fund of $169,000. However, we had $214,000 that is a receivable from the state or federal governments that should be coming in, probably already has come in, but at the end of the year, they still owed us money. So that's why our assets are $44,000, but we have an amount that's due to us from other governments. We also had a little bit of accounts payable at the end of the year and a little bit of accrued expenses. So our liabilities were $51,779, which still resulted us in a negative fund balance of $7,128 in the special revenue fund. The debt service fund had total assets of $4,227,000. We had $2.2 million worth of cash at the end of the year. Had the same thing with our property taxes, but these were property taxes that were specifically levied for the debt service program, $515,000 with allowance for uncollectibles of $72,000. We also have a due from other funds of $1.4 million, giving us total assets $4,227,807. We have the same unavailable revenues for property taxes like we did in the general fund. This is $543,000. So when we subtract those from our assets, we have a fund balance in the debt service fund, all of which is restricted and cannot be used for anything other than retirement of long-term debt of $3.6 million. Capital projects funds, we closed this fund out. However, we had a little bit of interest that came in after we closed it out. So we still have $222 in that fund. I guess now is as good a time as any to talk about this. You know, we have negative fund balances in our general fund. This is a violation of the state law. We have negative fund balances in several other funds we'll see later on. Also, the big issue that we have is we borrowed money from our debt service fund, which is a violation of federal law, state law, I'm sorry. So I'm probably not telling you anything you don't already know, but you'll see later on where we were required to spell this out. If you will turn to page 22 and 23, this is your schedule statement of revenues, expenditures, and changes in fund balance. We have our same 4 funds across the top of the page, and then the top is our revenues, then the middle is our expenditures, then we have our other financing sources and uses, and then finally our change in fund balance and what our fund balance is. Going down the general fund, we had total revenues for the year ending August 31st, 2024 of $19,663,985. You can see that $10,000,008 came from our local, basically most of that was your property taxes. We had state revenue of $7.3 million and then federal revenues of $1.4 million. Our expenditures in the general fund were $29,314,000. You can see the breakdown between instructional at the top, which is where the majority of your expense is, $13 million on down. We had a significant amount of plant maintenance towards the middle of the page. We had $4 million worth of plant maintenance this year. So again, our total expenditures, $29,314,000. We subtract our expenses from our revenues. We had excess expenditures in the general fund of $9,650,501. We had $2 million that was transferred in from other funds. We had $783,000 that was transferred out to other funds, which we'll see a little bit, a breakdown of this later on. So after the transfers, we actually had a decrease in our fund balance for the year in the general fund of $8,302,873. We started out the beginning of the year with a $6.9 million fund balance, so therefore we have a negative fund balance of $1,374,525.
One thing about that column, I believe, correct me if I'm wrong, in this case, general fund includes the child nutrition
That is
fund.
correct.
Along with your general, the two, you can't separate them because they're, in this statement, they're required to be combined together, so.
Years ago, and I don't know how this happened, but you're allowed, TA will let you either account for your child nutrition program in the general fund or as a special revenue fund. And years ago, it was decided, before we even came on board, that it would be included in the general fund.
So most of the money in the federal program revenue is the various child nutrition programs, and you'll see on the expenditures 35, food service, most of that is the cost of the food service program.
A question.
These are all actual expenses, right? We're done.
Yes. The special revenue fund, again, like Mr. Solomon said, this is everything with the exception of the child nutrition program. We had total revenues of $3,059,679. Our expenditures were $3,099,000. We would expect these to be equal out. That's the normal way that the federal programs work. Usually you spend the money in advance, ask for reimbursement from the state for the federal programs, and then they reimburse you. So normally we're used to seeing these basically, if your expenditures and your revenues should balance out to zero. We did have a excess, we do have some, and that's the way it is with all of your federal programs. We do have some state special revenue funds in here, and that's why we come up with the negative fund balance on those, because we actually spent more money in those than we actually received.
What happens if you're allocated so much money in federal funds, and sometimes you don't spend it all, and then the following year you apply for the same?
Correct, and if you, this is outside my area, but I think if you don't spend it all, a lot of times those funds will roll forward to the next year. Because a lot of these programs, they don't just end on August 31st. They cover a different period. So you have the opportunity to still spend those funds if they've been allocated and budgeted to you. You can spend them in the next fiscal year, even though that's for this 2023 project year. Am I correct
Yeah,
on that?
well, so it's backwards from the way you would normally think of it.
Yeah.
We spend the money first, and then we get paid for it. So you have to lay the money out. And then the other thing is, our fiscal year ends August 31st. For most of these are grants. Most of the grant programs, they end on September 30th. So that's a month later. So that could be why we have a negative fund balance, because sometime in September, we asked for that extra money, and it came in September because we were still in the grant year. So we expended
However, we
it.
will set those up as receivables usually to.
But-
that
Correct.
revenue.
I remember last year or the year before, you told us that the CAPE program falls under federal funds or state funds,
What's that?
career and technology.
No, I think what you're referring to is you did not spend your allocated allotment from TEA. And there are certain areas that they require you, when they give you your lump sum of state fundings, they're requiring you to spend a certain amount of it in specific areas.
55% for
Yes.
CTE.
But you don't spend it like I remember at that time you told us that we had underspent 241,000.
Probably in the career.
And I think this year we only got about 52,000, was it, because we didn't spend?
Right.
We got.
But you still spent that money you received, you just did not spend it on career and technology. In the federal program side of this, like I said, when you do your budgets for a federal program, you tell them this is what we want, and they will allocate that much to you. Again, if you don't spend that within the year, you still can spend that because that program in the federal's eyes has not shut down. So I think I don't believe you're ever leaving any of those federal programs on the table, no.
Yeah, so what you're talking about is something completely different
Right.
than federal programs. What normally happens in the federal programs is the federal government, let's say Title I, they tell TEA, you're going to be the grant administrator. And the last thing TEA wants to do is return funds. So you go through the year and let's say and I'm gonna make up numbers, you get $10 for Title I, and you spend $9. At the end of the year, TA does not want to write a check back to the federal government for the $1 you didn't spend. So they'll usually go ahead and get permission and tell you, we're going to roll your dollar over into the next year, and you'll be notified of that. Not before the year ends, but at some point after. And that's how they do it, because they don't want to, they get the money. They just haven't given it to us. They don't want to return it.
Now, while we're talking about federal funds, one of the things, the problem that we have is when they give you this money, they're going to say, okay, we're going to give you $10, but we're going to let you use 50 cents of this for indirect cost overhead. For running this program for us, we're going to give you 50 cents. In the past, the district has used that full 10 for funding the program and not taking that 10% back to the general fund as indirect cost.
So it puts it into a different column.
Right. So, it's, again, the money is all being spent. It's just that and in your case, you're school-wide, so you're going to have that, say that teacher in there, whether it's paid out of the federal funds or out of you personally, out of the general fund, really doesn't matter.
For Title I school.
But you are allowed to take those indirect costs back to the general fund to cover overhead. The next column on page 23 is our debt service fund. We had total revenues of $4.5 million. Most all of that comes from our local taxes. Our expenditures for our debt service, $2.6 million. We had $2.2 million that was for our principal on our debt service, and then we had $1.4 million for interest. And paralegal. The only problem is that we left about $1,000, or we got some more interest. So again, there would be nothing wrong, since we don't have this capital projects fund anymore, for transferring that $1,022 out, and making sure that it's in a non-interest bearing account for a little while so we can zero it out. If you'll turn to page 25, this is the statement of net position for the proprietary fund. We have a self-insurance fund, and that's what this is. These proprietary funds are for. We had a total assets at the end of the year of $882,000. We had an amount that was due to the general fund of $1.3 million, and because of that large payable back to the general fund, we resulted in a negative net position in our proprietary funds. Again, this is another violation of the state law. You can't have negative fund balances in any fund. You'll turn to page 26. This shows where our revenues, expenditures, and changes in net position for the proprietary fund. You can see that we brought in $2.8 million worth of revenue. We spent 3.6. So we had a operating loss in our proprietary fund of $565,000. However, the big problem was we transferred a whole bunch of money out of this fund. We transferred, and that's a typo, because we had the second line there should be transfer out, not two transfers in. So we had a total transfer out and a decrease in our operating income of $1,183,000, resulting in our negative net position of $417,000. Starting on page, let's go to page 28. This is the fiduciary funds. These are funds that don't belong to the school. These are mainly your school activity funds. However, we're required to account for these and present them. This is money that is not the school's money. It is the various different classes, cheerleaders, whatever. But of that, we had $96,000 at the end of the year. We had $680,000 that was due to other funds, and then we have $89,000 worth of fund balance. The next page, you can see that we brought in $34,000 in from our various different funds, student activities, you know, your cheerleaders, your class funds, et cetera. They also spent $150,000 of their funds, so they had a decrease in their net position of $15,000. However, they had $105,000 there to start with, so we have $89,000 left. Again, that is mainly there just for presentation purposes, and it's required by TEA, but again, these are not school funds. Starting on page 30 are the notes to the financial statements. These are the notes that are required by generally accepted accounting principles. These notes get longer and longer every year. One of the parts I would like to point out to you, if you will turn to page 38. This is a schedule of interfund payables. Top part of our interfund payables, the bottom is our interfund transfers. So this shows you that we, in the general fund, that we transferred $1.3 million in from other funds, or out to other funds, we transferred in, and this is the big one. You look up there at the debt service fund. We transferred in $1.4 million in from the debt service fund. And that was your big problem doing that. I don't know, I'm pretty sure that net amount is a lot higher than that right now, because I think this is just as of August 31st, but it's my understanding that amount is a lot higher now. Again, these numbers are as of August 31st, 2024. On page 39, this is the capital asset activity. Shows what happened during the year in our capital asset activity. And, you know, again, the increases, which start out with our beginning balances and our various different types of assets, and then our increases or decreases for the year and the ending. So the main thing I'd like to point out is, we spent $1.5 million on assets, plus we have $425,000 that was in capital construction in progress, mainly on I believe it is the stadium improvements and things like that. So, even though we were in a pretty bad financial shape, we spent over $2 million on capital asset activities here. If you'll turn to page 40, this is the changes in long-term debt. It shows what our various different long-term debts were at the beginning of the year, what our increases were, our decreases in our ending balance, and then the amounts that are due within 1 year. So the main thing I'd like to point out here is that, we paid down, we're still making payments on our note as of the end of August 31st. We are cranking those out, and if you'll turn to page 41, this shows what we're going to have to pay in the future years. So in 2025, we'll have to pay $2.3 million for principal and $1.4 million for debt. So that is what the debt service fund is set up to do, is to make these payments. There's a lot of these notes in here that are dealing with your pension plan and your other post-employment benefits. Again, this is information that basically you have no control over. It's just lifted straight out of the teacher retirement system, and then we place that in there as required. Let's move over to page 52. We're required to report that, any kind of budget variances that you have. And we'll see this a little bit later on, but basically you have negative budget variances in every function in your general fund. They were all negative variances. We also had negative variances in the child and nutrition program. So that's just specifying there what's going on. Note number S on page 53.
I could just make a note about so normally the unfavorable budget variance, what that is you started the year and you passed a budget. I'm not sure, I wasn't here during the year, whether there were any budget amendments passed during the year, but traditionally as you get towards the end of the year, because you now have a whole, 10 months, 11 months worth of actual, administration would normally come to the board and ask for a budget amendment to make sure you don't have a giant variance. In the business world, a lot of times you'll have a budget. That's your budget. If you miss, you miss. But for schools, no, you can't miss. You've got to have a positive number there. So best practice is come the 10th month, the 11th month, where you have a pretty good idea of where you're going to land at the end of the year, and you do a budget amendment to adjust each one of these items to what you think is you're going to actually land at.
Mr. E., you said we were negative in our food service program?
Correct. And we'll look at that in just a minute. Let's hold on to that thought, because we'll look at that in detail. This is just where we're required to report on.
All right.
We're going to see that in detail. Also on page 53 is where we basically are telling the readers of the financial statements that you used $1,418,000 out of the borrowed it from the debt service fund, which again is not a legal thing to do, so that you will be needing to replenish that in the future. There is an error here because I was under the assumption that you had already declared the financial exigency. Is that the way you say it? Apparently that is not. I saw I was under the impression that this was done back in December. So before we send this into TEA, I'd like to get that corrected, because that's not the truth.
Doesn't this have to be in tomorrow?
Yes. It's no problem. I can get that corrected really fast.
What needs to go into is like a PDF version.
Yes, right, yes.
So he just needs to type the correction.
Right. Also, again, we have here that, the decreases in fund balance. The district had a decrease in general fund balance of $8.3 million and a decrease of $1.8 million in the internal services fund. And as a result of this, we came up with our negative fund balance of 1,374,000 in the general fund and 417 in the internal services fund. One of the things that we have to assess is whether the district has the ability to be a going concern, which means that you can stay open for the next 12 months. And from what we were told by management, you have things in place. And so we were able to assess that it's probable that this will happen. So that's what basically that notice said. Now, let's turn to page 56. This is the general fund like we looked at before, but this time we're comparing it to your budget. Follows the same format. We have the revenues, expenditures in the middle of the page, financing resources in the towards the bottom, and then the change. We have our original, the final amended budget, and then what the actual was for the year on the page 57. And then in the far right hand is the comparison between that actual amount and our final amended budget. And I'm going to say right now that your budget was pretty much a mess. Included in your general fund budget was the debt service revenue. In other words, that amount. So your revenues budgeted revenues were overinflated by the amount of the debt service fund revenues. However, the expenditures were not. So it was a misleading budget to begin with. And we'll see that when we look at the debt service fund. So that's part of our problem, because we have, $25 million budgeted for revenues. However, our actual revenues were only $19 million. So we have an unfavorable budget variance in our revenue sides of $5,500,000. Now, that's not all of our problem, because our debt service, actual was only $44.5 million. So there's still $1 million variance in our revenues between what we anticipated bringing in and what we actually did. But when we get into our expenses, that's where it really falls off the rails, because we had anticipated that we were going to spend $18,508,000. We actually spent $29,314,000. So we had a total unfavorable budget variance in our expenditures of $10,805,000. And that's, and you'll see later on, we put this in as an internal control problem, because there was, someone should have been seeing this and knowing that we had a problem. I don't know when it finally came to the attention of someone and started looking into this, but this went on for a long time before anyone ever realized we had a problem. And as a result, I think there were some discretionary spending that was made, that might not have been done had you had good records. And so, again, I don't want to beat a dead horse, but that's the fact. And I think that you're trying to make steps or you have made steps to try to move so we can get away from that. We had a budget that said that we were going to have an increase in our fund balance of $6.6 million. That's what we had budgeted for. We said that we were going to actually bring in $6.6 million more than we brought in, where we actually, our total budget variance between what we actually thought and what actually happened was $16 million. So that's, again, that's the main thing is this is a someone was not looking at these numbers and giving you as a board, good information to know how to start adapting to what the situation was. If you will turn, we're going to skip a couple of pages and go into, in fact, I'm going to just skip it. Let's go straight to your budgets on the child and nutrition program. If you'll look at page 66 and 67, this is your child nutrition program. again, follows the same format. We have our budget, original budget, our final amended budget, and then what our actual is, and then the difference between a variance between those two amounts. And even in your child nutrition program, we had anticipated that we were going to bring in 1.7 million. We actually only brought in 1.5 million, so we have an unfavorable budget variance there of 177,000 on our revenue side. On the expenses, we had anticipated that we were going to spend 1.5 million. We actually spent 1.9 million, so we have a $401,000 unfavorable budget variance in our expenses. So when you total it all together, we had a budget that said we were going to have an increase in our fund balance of $180,000. However, it actually came in with a $398,000 loss. So there's a total budget variance there of $578,000.
I thought food service paid its way.
Not necessarily, but again, my point I keep trying to harp to is you have to have good numbers to know. And there's other things that we'll get into later on that I'll tell you that, show you that you weren't having good numbers to deal with. The debt service fund, this is one, I guess, other than the fact that you borrowed from it, it's a positive, other than the fact that, again, that we didn't budget for it. If you look up there at the top on the page 68, we don't have any budgeted revenues in this fund. They were just budgeted for in the general fund by mistake. And again, I can't tell you why that was or what happened there, but we did have a budget for our expenses. So, you had budgeted according to your budget. You said we're going to not have any revenues coming in. But we actually did have $4.5 million came in. So again, this came in with a positive variance there of $4.5 million. Again, I want to point out that wasn't enough to cover what you lost in the general fund, because even if we did put those numbers over in the general fund, you still would have had over $1 million less revenue in that fund. The expenses pretty much came in. It was just a different allocation between principal and interest, but in total, we had a $10,000 favorable budget variance there. We did transfer money in, and again, I don't know why that transfer in was done from the general fund. There was $83,000 transferred in from the general fund. So at the end of the year, the debt service fund has $3.6 million, which is, when you consider that you're getting 4.5, assuming that next year's taxes, 2025 taxes were comparable, we still have good funds to pay our debt with. But we might not have the cash because we're borrowing the cash to put into the general fund. So that's something that you need to monitor to make sure that, we have a plan to get this cash back into the debt service fund. Fortunately, probably with the current year taxes is probably enough to cover your debt service without even any fund balance. Again, I haven't got into that deep into it, but again, that's something that, the staff needs to monitor that to make sure that we do have the cash to make our debt payments.
Just as a point of reference on this, this was, we had a balance in that account of $3.6 million, August 31st. That's after we had made all of our required principal and interest payments. Then the year starts over, we collect taxes, we would make payments in February, payments in August with what comes in this year, plus whatever we have.
However, I'll caution you on that, is even though, just because you have a fund balance doesn't mean you have the cash.
No.
Because part of that cash was used to spend to loan to the general fund. For example, at the end of the year, you had $2.2 million worth of cash, even though your fund balance was $3.6 million. If you will turn to page 73, because you received more than $750,000 worth of federal funds, we're required to do what's called a single audit, which means that we have to do some more tests on your federal programs. One of those is to assess your internal control and compliance overall. And that's what this opinion is on page 73 and 74. And I would like to draw your attention to the last paragraph. It says, we did identify deficiencies in your internal control that are in the accompanying findings and question costs. So we're going to look at that a little bit differently. Also, the next page, under compliance, we did have, of those 4 items, 3 of those were compliance issues that are going to be reported on in our findings and question cost, which we'll see in a minute. Page 75, this is our report on internal controls and compliance only with your major federal programs. We're required to pick a federal program that will meet satisfy that it is high enough to meet as a major program. And we go in and do more extensive tests on that particular program. And in this case, our major programs were your Title I and also still our COVID-19 ESSER funds that we have left. We have still those were our major programs that we did on. And in those instances, we found no instances of non-compliance in those programs. Now, turning to page 78, our schedule of findings and question cost. Some of the things that I'll point out that are different than in the past, if you'll look under the summary of auditors' results at the top of the page, we did disclose that we did have significant deficiencies in internal controls. Then starting on page 79, this shows our findings. And the first finding is basically we had, I believe it was 53 different journal entries that we had to make at the end of the year. And because of these journal entries, you know, most of them were in your federal programs. I will have to say that too. Along with the budgets that we saw earlier, this is an indication that, you know, we have poor internal controls. We expect some journal entries, don't get me wrong. I mean, nobody's perfect, and we're picky. We come in and we want things moved around. But to have this level of journal entries, that tells us that there is a lack of internal controls. We as auditors are not supposed to come in and just, you know, fix your books. Your books are supposed to be in auditable shape when we get them, and they weren't. So that's what this finding is. Do you have anything to say about that?
Well, just, in summary, I mean, there are 4 findings. None of them were ones that I think going into this process that were unexpected. They're things that we've talked about openly amongst, you know, at previous board meetings.
We did discuss that earlier, the negative fund balances, that you had negative fund balances in the general fund, the special revenue fund, and the internal service fund, which are a violation of state law. Next page, under page 80, budgetary compliance. You know, you're supposed to have a budget, and that budget is supposed to be relatively accurate. You know, the fact that, you know, I did point out there that your general fund appropriations exceeded the actual amounts by $10,805,000, which is 58%. You know, that's, you know, to have 58%, you spent 58% more than you really thought you would. And that's just, like I say, someone is, I mean, that should have been a red flag for somebody early on, you know, because I guarantee this didn't happen right there at the end of the year. Mm-hmm. So again, to have that level of journaling of budget compliance issues, again, we saw earlier, every function in your general fund, you know, was what had a budget variance. Every function in your child and nutrition had a negative budget variance there. So these are major concerns for us. And then the last one again is dealing with the debt service fund, borrowing money from the debt service fund. Debt service funds are strictly to be used for debt service and debt service only. Now, once you get your bonds paid off, if there's money there, you can move it wherever you want to, but until those bonds are paid off, any money that comes in has to be spent for debt service, nothing else. And I'm sure, you know, I think you have already self-reported this to TDA. Am I wrong on that? Yeah. So sure. It's not something that they don't know about, but you'll probably be hearing from them on this if you haven't already. And then on page 82 and 83, this is information that was received from the school district of what they're planning to do about this. Mainly that, for years, we've been telling you that we recommended that you hire a full-time business manager. And I hate to say it, but I think you see why we're so insistent on that. Nothing against consultants, but there's a lot can be said for having someone in-house, day-to-day that sees this and can devote 100% to it. So that's a help. I believe that, again, we've contracted with someone to come in and help. I don't know what Mr. Kim's responsibilities are, but you're taking action on that. But it's going to be a hard road. I'm not going to sugarcoat it. I mean, it's just like, for example, I got in trouble with credit card debt early on in my life, and it takes a long time to get out from doing that. So it's the same thing with the school district, because not only do you have to balance your income and expenses in the current year, but you've got to make money to make up for what you've done in the past. So it's going to be a tough road for you. Starting on page 84 and 85, this is the schedule of expenditures of federal awards. This shows the various different federal programs that we did receive money for or spent on, and our total federal expenditures were $4,272,000. Again, that's going through it pretty fast. Inside your audit report, the very first page, there should be some individual letters here. And this is the first one, the one I'd like to discuss. It starts with, as part of our engagement. Basically, this is our management letter to you. It's basically just going over the same information we talked about. I mean, we've gone over all this before, but we had, it's kind of goes more into detail of what our problems were with the federal funds. We had, a large number of adjusting entries. Of course, the negative fund balances and then the budget variances in all funds, and then our debt service fund problem. So again, we're required to present this, and this letter will have to go to TEA also too. So, questions?
I got a question, Peggy, a while ago, did you get an answer?
Oh, yeah.
Sonia? Mr. Martinez?
I guess, typically, the budget variances, when would they start being noticed, like during the actual year? I mean, at what point would you say?
If you want the legal answer, you're not supposed to spend anything unless there's a budget there. So, the main thing is we had a terrible, unrealistic budget to begin with. And I remember sitting here last year when I was with you.
Say the same thing.
And I was telling you that, you had received over $8 million in the past 2 years from ESSER money, and that all my other school districts were increasing their fund balances, and that you had a decrease in your fund balance. But at the time, you had a balanced budget for next year. And I remember telling you that, I don't know if those numbers are correct, but, if that's the case, more power to you. But apparently you were given some bad information.
I would say, Mr. Martinez, in terms of different parts of the budget, you'll start to know at different times of the year. So the revenue, you'll know, like tax revenue, you'll start to get information once you get into October. Before that, there's some element of you're guesstimating.
Majority of your tax revenue is in by this point in time. So if you haven't made your tax revenue, you're not going to. You can count
At this
on,
point, until like end of January.
you can count on your payroll being relatively equal, in my opinion. It's pretty much a 12th every month, is what you can count on. Again, you had a lot of big projects. We had a lot of building projects there. I think there was some still in process that you haven't been able to fulfill, but again, as a business manager, you shouldn't be spending that money until you come to the board first and say, hey, board, we don't have this money. What do you want to do about it? Do you want to, so that, again, those numbers should have been known by someone within the organization.
And we are working on a budget amendment for this year to come back to this board in February and correct last year's budget, because again, the budget that's been adopted for this year that we're operating on is again a balanced budget, but it was created in the same manner as last year's budget.
So when, in your audit, it doesn't say who exactly, where exactly, like for instruction, we spent $2.1 million more than what we should have. Does it say how we did?
I won't say that. Now, I could find that information for you, or your staff could, but, again, I'm sorry, I didn't do that, the fixed asset part of this audit, but if I did, I could give you those numbers exactly. I do know that the 425 million that's in construction in progress was for
425,000.
425,000, I'm sorry, that was for the improvements at the field. I think that
There's another.
a scoreboard. I think we had a pretty sizable amount for scoreboard. Another big, I do remember this, that you spent a lot of money for bat remediation,
Yes.
I believe. There was like over $200,000 to $300,000 that was spent to remove bats. Where those were, I don't know, but there was a
Not
size.
instruction.
Well, that's a necessity. The other ones were bad recommendations to us.
The fence was another one that.
Yeah,
also-
and that one hits a lot of our school districts this last year, because there's a lot of this safety stuff because of our Uvalde shooting that, no telling how much that has cost the state of Texas school districts, and the state doesn't just pony up their fair share of that either.
That's exactly what I was gonna say. I mean, they mandated that we,
It's an unfunded
Yeah.
mandate, yes.
safety, things that we needed to do, and they told us you gotta securities, officers, fence, this, that. We never got hardly anything, I mean. from that.
We're seeing that over all of our school districts, that they're, the unfunded safety part of it.
I would just say, just in terms of like, where was the variance? It was all over the place, and it's really hard to nail it down and go, well, it was this. Or we could tease it out and give you, if you really want information, like, why did we miss on instruction by $2 million?
Yeah.
How much of that was payroll? How much of that was non-payroll? We could give you that information. In the end, it's in the past, and I think, as you said, he was surprised going into the budget that you're looking at that had variances, that it was projected to be balanced in the first place. And it's not surprising that we missed, it's the magnitude. That's what it was. And then I think that's a combination of one, that the budget wasn't based in reality. And then there didn't seem to be any tracking of it throughout the year. So as things were off, there wasn't anyone raising their hand, coming to the board, coming to Ms. Briones and said, hey, we have a problem last January, last February, in March, and said the school year just continued to proceed through. And, in some of these cases, we were probably over budget in March, April already, and we're out of budget money, but no one came to this body and said, hey, this is a problem, we need to do something about it.
I don't have anything to base this on except a gut feeling, but probably it wasn't until you ran out of cash that it became a problem. When all of a sudden we didn't have cash to pay bills, that's when somebody started looking and saying, what's going on?
What incompetence?
Well, for the last 3 years, I mean, when you made your presentations, you came to us and you strongly recommended that we had our own business office. And you came another year, strongly recommended that. And he came again, and finally, I mean, this year, we were able to put it together. And on that thing that Mr. Sullivan saying, well, nobody came to question it. Yes, we were questioning the person that was in charge of, finance. And everything that we had, don't worry about it. I mean, we as a board really, I mean,
You hired someone.
we believe the person was saying, I mean, even when we adopted the budget for this current year, I mean, he said it's about balanced budget. I mean, we're not gonna go back and check, well, was this taken out of the debt? We just took it for granted that what he presented to us, we had the money and that it was gonna be a balanced budget.
He's right. I mean, a lot, some of us, especially some of us, kept asking him, whoever it was, and I know you don't want to go behind, but it was simple. He couldn't provide an answer. And I'm not that smart. I'm probably not the smartest here or anything, but she's pretty smart, and I know she would ask him, where's the
There's no
stuff?
wiggle room. There's no wiggle room. You could never get an amount.
Where's the stuff?
From anybody.
Documentation. I forgot it. I'll bring it 2 weeks later. I'll bring it 3 months later.
I think the one thing, I'd like to get across to you as a board is don't take anybody's word for it from now on,
Yeah, ask,
Make them.
Justify.
produce documents to show.
Right.
I don't know if you were getting, financial statements on a monthly basis, but,
I asked for revenue and expenditure for the last 3 years. I gave up. We used to get them so we could kind of follow, but I finally gave up. We didn't get them.
again, this is what you hire somebody for, but you still have to, someone needs to know that this person is doing their job, so, at the least, I would like to see you start getting, very simplified financial statements that would at least show you where you stand, so it won't come as a complete surprise. Again, it wasn't until we ran out of money that we realized we had a problem, so.
And I think we can go, I want to go back and say, well, I mean, that's a pass.
That's right, woulda, coulda,
We
shoulda.
have to now move forward and
And unfortunately, I didn't want to sugarcoat it. It's going to be hard. It's going to be very hard. You're going to have to make probably some hard decisions that are not popular, but, unfortunately, that's the only way to get out of this. So,
any other questions?
It's an action item.
Okay. There's some more questions. I mean, we're gonna go ahead and, back to item A, discussion action to approve the, district annual financial report for the, year 23-24 school year, ending in August 31, 24. Ms. Arones?
The recommendation is that the Board of Trustees approve the district's annual financial report for the 23-24 school year ending August 31st, 2024.
It has to be submitted to Tuesday, so, I'm gonna make a motion that we approve it. And, because it's something that has to be submitted to the state. I don't know what would happen if we didn't approve it, or can we send it unapproved?
again,
I think that would probably just result in more problems with the district, not
What I'm
less.
saying, I mean,
I mean,
have to, I mean.
I second the motion.
Oh,
just in plain talk, this happened. You could put your head in the sand and pretend it didn't happen. Mr. E prepared this audit and went through the audit in the appropriate way, and we provided our information, and he audited it the way he's supposed to. Unless you have an objection to that he did something that was in some way wrong or inaccurate, or that you believe that the numbers he's reporting on don't reflect reality. There are situations like that where I've heard of school boards saying, we are not going to accept this because you created this whole, what we believe as a school board is a whole other fiction about what happened, and that's not, that's not the reality. I could see that, but with respect to this,
It is.
That's why I'm making the motion, because
So I second it, sir.
we have a motion, we have a second, concerns, discussion. Not all in favor?
I guess-
There's a question.
I guess, these letters are dated January 10th, and, that's,
Yes, that
I'd like to
is,
see these at least a little bit earlier instead of right now.
I would love for it to, yes,
That's the only discussion I have.
yes. In fact, we had discussed this last year at this time too, that we wanted to start earlier, and we did start earlier, but unfortunately, the problems that you had made it last a lot longer. But yes, I agree with you. We would love to have this where you have it in hand. I literally was printing this before I left because I finally got a response back that I needed to put in here. So yes, I agree with you.
More discussion, questions, and
And that we need to make sure that it's noted, those corrections need to be corrected before it's submitted to.
The references to the financial excellency will have to be removed.
we're gonna vote on
We're
it
gonna do it.
to make sure we get it.
Yes, once we vote on this and everything, this will be posted on the website.
Yes, we have to
But
submit to
see,
TA.
It'll be posted on the Crystal City website.
The corrected one.
The corrected one.
Okay, let's take a vote. All in favor? So no, motion passed.
Thank you, Mr. Reed.
Thank you, Mr. Reed.
Okay, action item, B, discussion to approve the declaration of financial entity and authorize submission to TA. See, Mr. Onis, can you let them know why?
Just the rationale behind this is just that we have to resubmit because we exceeded the 20 days. The holidays got in the way of the submission, so we have to resubmit to TA. So essentially what you're doing is voting again tonight for the declaration of financial exigency.
President, so move.
Well, Ms. Bronis,
Wait,
you go ahead.
we have a motion, Mr. Bonilla, do we have a second?
Second.
Second by Mr. Mata, questions, discussion?
We approved this on December the 6th. And I look over here on the day that it goes out. If I'm reading this correctly, we sent it on January the 10th. And they
Yes.
received it on the 13th, or how are we reading these dates?
They should, I don't know, they go out direct mail. I don't know, Anna, unless you know when TA received it.
It says in our-
But my problem is, December the 6th was a really long time ago. I don't see how this didn't get out in the correct time.
Yeah, we submitted on that date.
On what day?
So TEA is just,
January the, no, January the what, Anna? Because you scribbled.
Went out on the 10th.
It went out on the 10th.
You received it.
that's a long time from December the 6th.
Well, you gotta remember, Peggy, that around that time, I mean, towards the holidays, the mail, gets backed up and all that. I'm not putting an excuse.
I don't
But we
buy it.
submitted late.
Why, what happened?
I don't see how we don't take care of things.
What happened?
We submitted late.
Why?
I feel like it's too long.
I just don't get it.
Got mixed up in the who's supposed to submit, is it supposed to be
That's a,
business
yeah, I'm not.
department, my department, Carrie, who's supposed to turn it in?
Who was,
Not even Christmas
The
crop
business
last
department
time.
needs to turn it in. So we ended up turning it in.
and now we gotta do this again, huh?
And it's gonna be mailed tomorrow or
Tonight.
tonight?
Are you sure?
Or
Is the
Yeah,
business
we're
gonna do it,
gonna
or
do it.
who's gonna do it? Business
Anna and
or?
I are gonna do it.
does this affect any of the decisions that we've made?
No, because it's a record that you all voted for the original one. You all still voted on December the 6th. TA just,
But I mean,
Has to approve
technically,
it.
technically it hasn't been submitted, so I don't know if there's any can come back or anything legal wise that can happen?
I believe so, but we can discuss it with the attorneys.
My understanding is that, that's why they sent us back the letter,
Yeah.
so that we
Mr.
could resubmit it,
And I did visit with Mr. Cruz, and Mr. Cruz said we just had to resubmit.
so. Okay, all in favor to, you make the motion, right, sir? And, was there a second?
Yes, Cruz.
Mata, all in favor? Against? Okay, 5-2, 4 and 2, against, motion. Did you
Abstain.
One abstention.
So it's
Four.
5-2.
4-3-1, 4-2-1.
2-1.
2-1.
4-2-1. Go to closed session. Okay, at this point in time, we're gonna go into closed session pursuant to Texas Government Code, Section 551, 074, and 551-071, and the opens meeting act, and the time is,
It is 6:42.
6:42.